Today we are going to be looking at the subsidiary book and we'll be looking at the cash book. Alright, we have dropped videos previously on subsidiary books, sales day book, purchases day book, returns inward, returns outward, and a general journal. So today we are going to be looking at a special subsidiary book known as the cash book. I said it's special because it's a part of the subsidiary book and it is also part of the ledger account. So a cash book is that special. Alright, the cash book records transaction that has to do with immediate payment. Either cash was received at the point of transaction or cash was paid, okay, where cash was directly involved in the transaction. That is, there was no delayed payment, no later date, okay, the cash was paid or received immediately the transaction occurred. So every transaction that has to do with money received, money paid is recorded in our cash book. So our cash book is a book of original entry, that's a subsidiary book, and it's also a part of the ledger account. So I'm going to be showing us the format of the cash book very quickly. Like I said, this is a part of the ledger account. That means it also forms part of the double entry. I'll be speaking on double entry in our next video, right? So, well, just understand that since it's a part of the ledger account, it's a part of the double entry. That means it has a debit side and a credit side. All right, so our debit side records all the receipts, okay, all the receipts, and our credit side records all the payments. So all the receipt, money that comes into the business is debited, money that goes out of the business is credited. Okay, so our format is very easy. This is our divider, alright, separating our debit from our credit side. So we have our dates, our particulars, our folio, and then amounts. Similarly, we have the particular, folio, and then the amounts. Okay. Alright, so the format I just showed us now is what we call the single column or the one column cash book. Alright, the format we are seeing here is our one column cash book. One column in the sense that only one column is given for amount. Alright, only one column is given for amount. Now in our double column cash book, we'll be having two columns for amount. So we'll be looking at that in our next video. Alright, now this is our cash book format and it's a one column cash book. Okay, so this is it. So one column cash book has to do with immediate payment. In this case, maybe the business does not have a bank account. So all that it deals with is just money, actual money received in the hand. So here we are dealing with what is called the cash at hand. Alright, the cash in hand. The cash was received by the business in the hand. So it's only a one column. The business does not have a bank account. Alright, that's why it is called the one column cash book. The one column is for amount. So to that effect, we'll be taking a question and we'll be learning on how to post to the debit side and to the credit side, and as well as how to balance our account. Alright, so we have an illustration. So we have that we are to write up a one column cash book from the following transaction of Mr. Steven for the month of August 2015. So our date is going to be on August 2015, okay? And then we are going to balance it off for the month. So on 1st of August 2015, we have started business with cash. Started business with cash, that when we see started business with cash, is an accounting terminology that is used to refer to capital, the amount that is used to start up a business. So it means cash was coming into the business as capital, right? So we'll be entering that on our date. We have 1st of August 2015. So our particular will be capital because we are having started business. The money used in starting the business is what we refer to as our capital. Alright, we can see the folio in our ledger account, okay, in the capital account, in our ledger account, and then the amount we have here is 5,000 naira. So we'll be entering under the amount 5,000 naira. All right, so it's on the debit side because money came into the business. Like I said, this arrow should direct us all the money that comes in, all the money that goes out. So we have our debit side for receipt and our credit side for payment. All right, now the next transaction we have is on the 2nd of August. All right, on the 2nd of August 2015, we have purchased goods of 2,000 naira by cash. Purchase goods of 2,000 naira by cash. So in this video, we'll be trying to explain some terminologies. All right, now since we purchase goods, it means money is actually going out. Okay, money is actually going out of the business. So we'll be entering on the credit side, all the money going out, payments. All right, so we have purchase goods with card. That is on the 2nd of August 2015. Now when we purchase goods that the business hopes to resell, all right, when the business purchases goods that it hopes to resell, we term it as purchases. Okay, now but when the business buy other assets or maybe other things that it do not hope to resell, then we call it by the name of the assets. For example, in this case we have purchased goods. The goods in this case is what the business usually trade in, what the business usually sells. So we're referring to it as purchases. But if they had purchased an asset, let's say a motor vehicle for cash, then we would have referred to it as a motor vehicle, because in this case it's no longer a purchases, since the business do not hope to resell the motor vehicle. Alright, so when we buy goods for resale, we call them purchases. That's the accounting terminology used. So we have purchase goods worth 2,000 naira by cash. So our particulars will be having purchases. Okay, and our follow will be the purchases ledger, and our amount is 2,000 naira. Alright. Now, the next detail we are having is on the 15th of August 2015. We have sold goods worth 3,000 naira by cash. Like we said, since when we buy goods for the business to resell, the terminology we use is purchases. In the same manner, when we sell the business goods, that's what the business is trading, the terminology used there is sales. Okay, we refer to them as sales. So when the business sells its normal goods, it's called sales. But if they sell any other assets, then it is no longer part of sales. We now refer to the assets in the particulars. Alright, so we have on the 15th of August, we sold goods worth 3,000 naira by cash. So our date is 15th of August. So we have sales. In the sales ledger, we can find this worth 3,000 naira. Alright, our follow is a reference document where we can find similar transaction in another book. Okay, so that's why we can also find this in our sales ledger by the rule of double entry. Alright, so the next one we are having is on the 20th of August, we paid wages by cash. We paid wages by cash. That means money was leaving. Okay, money leaving the business will be credited, money coming in. So we must be able to analyze that. So when we pay wages, money is leaving us to the worker. The business is paying wages, so it's paying the worker. Money is going out. Okay, so we paid wages on the 20th, wages of 200 naira. All right, so we paid wages. Our date is 20th of August 2015. So our particulars here will be referring to wages, and we can find it in our wages ledger, okay, or wages account, worth 200 naira. Good. So we are through with that, and then we have that on the 25th. We paid electricity bill by cash, 500 naira. So that's also an expenses on the business. Money was also going out. So we'll be crediting our account. Where money goes out, we'll be crediting. Where money comes in, we'll be debiting. Alright? So on the 25th, we paid electricity bill by cash, 500. So on the 25th August, we paid electricity bill. So our particular is going to be having electricity bill, and then we'll be finding it in our electricity account in the ledger, alright, by cash, 500 naira. So everything involved in this case is just cash. So there was no bank account, no check involved. Alright, and then on the 28th of the same month, we made sales, cash sales, 2,500 naira. So that in this case, money is coming in. although with goods were going out, but money was coming in. All right, so we'll be debiting our account for the sales, card sales of 2,500 naira. Our follows in the sales ledger, 2,500 naira. All right. We also have the last one on the 31st of the same month, 31st of August. We withdrew cash of 400 naira from the business for private use. So when cash is withdrawn for private use, the terminology used there is drawings, okay? When cash is withdrawn for private or personal use, that is the proprietor or the owner of the business withdraws money from the business for his own personal use, is known as, the term there is known as drawings. All right, but when cash is withdrawn for business use, it is not drawings. We'll be explaining that in our next video. So in this case, we withdrew cash for a personal use, private or personal use. So the terminology, the accounting term used here is drawings, okay? So if we are withdrawing cash, that money is leaving the business. So we'll be crediting our account, okay? So on the 31st, the terminology used here is drawings, because money was withdrawn for personal or private use, okay? So we'll be seeing this in our drawings account. In our drawings account, and the amount that was withdrawn is 400 naira. So these are all the expenses that was made for the month. It is normal with our subsidiary book that we balance off at the end of every month, okay? Now when balancing, I'm going to be showing us in this video how we will be able to balance our account, where the concept of balance carried down and balance brought down. So we're going to be balancing. What we'll do is, now in our I will be adding our debit amount. This is our debit amount, right? And our credit amount. So we'll be getting the total for the debit amount, the total for the credit amount, and then we'll be comparing which of them is bigger. Because at the end of the month, we must make our account, the debit and credit side, to be equal. In accounting, we want this amount to be equal. So we're going to be totaling this. We'll be using this side. For the debit side, we'll be totaling 1, 2, 3, and then we'll be having 10,500 naira. For our credit side, we'll be totaling this, okay? All this 2,200, 500, and then 400. So we'll be having 3,100. All right. So this is our credit total, this is our debit total. Now, like I said, we must, at the end of the month, we try to make our accounts, the two accounts, to agree, to be balanced, okay? So we want to make this account balanced, but we can see from this that our debit side is greater than our credit side, right? Our debit side is greater than our credit side. So the only way we can make our account to balance is to introduce what we call the balance carried down and the balance brought down, okay? So in bringing our balances, we'll be lessening the credit side. We'll know the difference. We'll be lessening the credit side from our debit side, which is the bigger side. So when we less this, we'll be having 7,400. So this is our balance. This is the difference between the two accounts. That's what we refer to as our balance, okay? We'll be bringing this balance to the smaller side to make it agree with the bigger side, okay? Hope we're not getting confused. So we'll be taking the balance, which is the difference between debit and credit, all right? We'll be taking the balance to the smaller amount, the smaller side or the credit side, okay? We'll be taking our balance here at the end of the month. The end of the month is 31st, okay? The last day of the month is when we balance of the account, the last day. So the last date is on the 31st. So we'll be balancing our account on the 31st of August, okay? And our particulars here will be our balance carried down. So we are balancing, that's our particular, this amount, right? There will no longer be a folio in this case. So this amount is 7,400 naira. So when we balance, we can be able to add on the same line, okay? On the same line, so the same amount. So we'll be having this. In this case, we have been able to make our two sides to agree. we have been able to make both debit and credit side to agree by introducing our balance carried down, okay? So we are balanced off for the month. But when going to the next month, we will have to show, okay? We will still have to show that there was a balancing, okay? So since our balance carried down is on the credit side, we'll be introducing our balance brought down, alright? So at the beginning of the next month, we'll be introducing our balance brought down, in this case to the opposite side, okay? Since it was carried down to this side, we're bringing our brought down to the debit side. So at the beginning of the next month, after August, we have September. So on the first day of September, we'll be bringing our balance. In this case, we are bringing down this balance. So it is now a balance brought down. Alright, here it was carried down, here it is now brought down. This same amount, 7,400 naira. Alright, so this is how we balance off our account. To make it agree, we have to introduce balance carried down and balance brought down. So this is typically the format of our one column cash book. With this, we are coming to the end of today's lecture on one column cash book. If you've not subscribed to our channel, if you've not been liking our videos, please do so. Share our videos with as many as you can. We'll see you in our next class. Thank you.